Please click the like, share, and welcome to all the new subscribers. Let's go.
References from home interface. Systems are now fully operational.
Yes, we're here. I'm in a preview red and white, right? Nothing simple. Tomorrow I'll be in my gears, all set. Yeah. Look a red stripe with white, killing it. Yeah. What make them fight with so hard? Bless up, brother. Zines. Anyway, yeah. We're in the place now, and we are looking on pound pairs, right? I was hoping I would see Sadiq in the room right now for him to ask the question, right? So the thing is, let's just highlight this pound as pair. I would like to know if everyone is hearing me. Let me know if everyone is hearing me loud and clear. We know that YouTube is lagging. We know that YouTube is lagging. Right? So yeah. So let us go down to the 50-minute time frame. Right? 50-minute time frame. We had a huge move buy off in the market within last night and this morning, right? But the news was, right? The chancellor resigned, or was fired rather. In my opinion, he was fired, right? And that's the reason why we really get the buy off, right? But the thing is, the person who they put in his place, right? His name is, I think, is Rashi Sunak. Excuse the Spanish if I'm getting it right, but you can look it up, right? So the market anticipate that this new guy, I should have called him Sunak, right? He's kind of a stimulus guy, right? He like to stimulate the economy. It's like the chancellor who was before was like anti stimulus, right? In that word, in other case, in other words, it's like we have the Fed where the Fed normally like inject money into the economy, right? Like print money, right? So this new guy that they put in place is likely to stabilize the marks to stabilize the the GBP economy, right? But basically, I'm a bear on the GBP pairs. But for me to change my policy, I would have to be yeah. For me to change my policy, I would definitely need some more information, right? For me to just change my bias on the GBP pound pair, right? Cause remember now, we exit the Brexit, we exit the UK, but we still have a long ways to go, as in which we are supposed to the GBP UK is supposed to deal with trade deal and border crosses and a lot of things, and they are expected to cover all of this within an 11-month time span. In my humble opinion, I don't think it's going to happen, right? So that helped me with my bias. But this is just a volatility move. What happened today? But I was trying to get good night, big boss, good night. Yeah. So I was trying to explain to him what really happened, right? So before good night again. So before I look to my charts, right, and normally look to the news or the economic calendar to know what's going on, right? Because we don't want to take a trade at the time where a news event is going to come out or something like that, right? So I normally look to my chart, look to my news era, so and then I'll just take it from there, basically. That is how I really do it, right? So, but basically, we are on the that covers the GDP pair, right? A note on the GDP pair I would like to address in the group, right? In our Jamaican Forex group that we have here, right? So, yeah. So, right. So my friend don't really understand the monetary, I think about monetary policy and how them how really inject money into the economy, right? Because we know the central banks we just print money, right? We just print money. So I'm gonna look at a few charts, right? But I'm gonna just take a quick second if you don't mind. I'm gonna draw like a monetary policy, real quick, for you guys to let you explain, to help you with the explanation. So the reason this helped me to get my bias on peers, right? So this helped me to get my bias on peers, right? So if money is expected to pump in the economy, which is free money, I want some of that free money, right? I want some of that free money. So that is the whole idea. And all I'm trying to do is just follow the money. Where the money goes, I just follow the money, right? So I'm gonna take a quick look. I'm just gonna do a quick graph. Not in too much details, right? Not in too much details. Alright. I'm gonna draw this line right here. This line right here. Right? And this is interest rate. I'm gonna label it. I'm gonna label it for you guys. Right? But I'm gonna draw, see this line right, this blue line right here, we can call this the demand curve, right? Which is the demand for money, right? So this line right here, now I'm gonna get to the labeling. To just a minute, I'm having a bit of a lag. So we are gonna call this interest rate. T, interest Alright. Excuse the writing. I'm not that such a good of a writer, but I like to know if you all can really see it. Right? We have interest rate right here, and we have what I call some money. M O N E Y, which is quantity of money. So we just put alright Q U I'm just gonna do a basic package. Quanty, right? Quantity, put the O F of money, right? So that call is Q, or that call is R, which is interest rate, right? So in a perfect world now, in a perfect world, real quick, I don't want to take too long, but I have just bear with me a little bit. I have a little lag, right? System may be over under a lot of load right now, right? I'm changing the color. We don't want to get confused here, right? I'm getting into the nice, juicy section where you all want to see, right? Just bear with me a little bit. I'm going to use black for this case, right? So I'm going to draw this line right here, right? Something like that. So now I'm gonna right, and this would be R1, and this would be Q1, which is interest rate, right? And this is quantity of money, right? So right. So in order, I didn't label this blue line right here. This blue line is supply. No, I put the demand curve rather. Just a minute. Which is the demand for money. Drawing turbo. Demand. C-U-R-E-E. Alright. You get the idea. Right? I need to sharpen up on the writing here. So this is the equilibrium, right? This is the equilibrium right in this here, right here, right? So this is the supply curve, right? Sorry, the demand curve for money, right? The idea of getting increased demand for money, right? They need to make it more accessible, where people can spend more and more, spend more and things like that, So the idea of that, where them by the one of the stimulus with one of the monetary policy, where them insert money into the economy to encourage spending. That's the whole idea, to encourage spending, right? That is the whole idea, to encourage spending. So, excuse the drawing. So they are trying to target in this area right here, right? So this is the idea, right? So this will become Q2, and this become R2. So as you can see on the demand curve for money, the lower it get, the lower interest rate get, right? The demand for money increases. And the reason why, as I'm saying, is a part of stimulus to GDP. They normally do this stimulus when time you have things like the GDP maybe too low, right? To encourage spending, right? Remember now, when the interest rate is like this high, it don't influence borrowing because it costs too much to borrow money for you to spend it, right? So you don't really want to borrow. So let's say this is at 5%, right? So up here is 5%. It's gonna be crowded if I try to write it right now. But let's say this is 5%, right? 5%, right? Let's say they carry it down now to, let's say, 2%. 2%. In other terms now, you will be more encouraged to borrow some money to can spend because it is cheap. It's cheap to get money, right? It is very cheap to get money. So this is one of the um, tools them that they are used that the central bank use, right, to get things going. They get like the GDP going, and you have the inflation. Sorry, excuse me. Sorry about that. Inflation, right? And as we know, the Fed is trying to keep inflation around the 2% area, right? So they are doing some stimulus packaging, right? Them use some stimulus in the economy, right? And all what the Fed did last year, right? Last year, they were buying bonds. They were buying bonds last year, right? So what they do, they print money, like not like physical money, but like money like just type in some numbers. That's print money, right? So they type in some numbers, print the money, and we're buying bonds. And bonds was like it's a IOU note, right? A IOU note say that you're going to get interest from a particular company within X time, right? So basically, you buy debt, right? You buy debt from the company in order you get X amount on what you lend them, rather. So now the Fed now print the money now, magically print the money out of thin air and just buy the bond from you. And after you then buy the bond from you, there's a money multiplier. But I'll get into that another time, right? So the money multiplier, I multiply the money, right, based on the reserve rate. I think the reserve rate is 10%, I think, right? So how that really work now, right? So let's say the Fed buy the bonds, right? Same buy 100 million worth of bonds, right? So me now, who sell the bond to the Fed, right? Me end up have 100 million. So the 100 million when me have now, what I did, say I put it in the bank, right? I put it in the bank. So now the bank now allowed to keep say 10% in reserve of your money. So whenever we deposit our money in the bank lend our money out. Basically, the bank lend our money out. If somebody else go to the bank for a loan, chances are good at your money, right? Your money, right? So the bank keep 10%, which is required of the capital you deposit, 10% in reserve, right? And loan out the rest, right? And when you do the math with 10%, you do the maths with the multiply with 10%, it come out to 0.10, right? And when you multiply that 100 million, I think you get like a billion, right? But I'll further elaborate if you guys need any further detail. But this is an intro to what I'm trying to say, what I'm saying rather, right? So let's just go to the charts where everybody would like to see the charts, right? Because it's all about the charts. So through that, so with those central bank policy and macroeconomics and risk on, risk off, I know exactly what I want to do before I even look on my charts, right? This helped me with my bias. That's why half the times when I come to my charts, I'm more like say you're a bull or a bear, you're a bull or a bear, and then you know your setup. Quite easy. It's easier for you to be a bull or a bear rather than to be both of them. Like boathy. You're on the two side. You know? It's easier to find a setup being a bull or a bear. Right? So let's go back to the pound pairs. Right? So based on what is going on, you can even decide, say, based on the stimulus, what is going to happen, what's going to take place, you is a bull on the currency. So the only job you have is to just buy dips. Buy dips. Right? Buy dips. That's the only job you have. Buy dips. Because you're a bull on the currency pair now because of whatever that means to you. Right? But back to our charts now. Where the pound as is concerned, we are back at support. No, we are back at resistance rather. We are back at resistance, and this is the monthly resistance, right? Based on the pivot points, the monthly resistance. So, for example now, if you are a bear on this asset, let's go on the 4-hour time frame. If you're a bear on that asset, right, you have all right to be selling at that price, right? Because you're looking at this down move right here, and you're looking at this pullback right at the central pivot point, and you're looking at this play. This is a monthly play, and also this is a monthly. It also collaborates with a weekly M3, and the weekly play you normally take profit right around M1 within that zone right here as a weekly play. So right away you find out what you want to, where your price is at, right? So let's clear it up. Let's change the color now. Cause I like to show a bull and a bear perspective. I don't just like to show one direction, right? I don't like to show one direction. So basically, next week trade plan is being a bull now. You don't want to pull back within at around 1.9350 or 1.9. It's in my way, but around M2 era, right? So they want to pull back to somewhere right in here, right in this zone, because this is a buy zone, to continue the move up to take your profit, right? And this is next week we are talking about, because the week is already finished, so we are planning our next week trades. So this is our trade plan, right? So at the moment, bears get the price where they want to sell. Bull don't get them price yet, because we can't buy high. We have to wait for a pullback, basically. Alright? So, yeah. Within the week ahead, from the week open, right, we had a little risk on in the market. We had a little risk on in the market. That is really why we see the Swiss franc and we had a little rally in the yen pairs also, right? Because of risk on in the market. Definitely. So we had that play set up, which we already anticipated that move from last week, say we are expecting some form of rally where the safe event currencies are concerned, right? So we are just going to take a sneak peek at that real quick before we close off the session. I don't get a lot of turnout. That's what I would expected, because I would like to answer all of you guys' questions in the group, right? And in general, rather. So after this, what's happening? It's taking forever to load. Wow. I don't know what's happening. Yeah. Cool. And this is just let us just use Aussie, for example. Australian Japanese yen, right? Australian Japanese yen for the closing of the show, right? So as you can see right here, this is the price we were thinking about getting involved, 72.45 445, right? Where the risk on. So this happened last week, not this week, last week, right? So we had some risk on last week and it rallied up, right, to the take profit zone for last week. So M2 goes straight up to M1. So this was the trail plan for the week, right? I think this went up there about Wednesday. I think it was Wednesday. It went up pretty early in the week, Wednesday. So now, as a bull, you'll be waiting for the pullback, right? And the pullback would be 72, 82.30 or around 73.30, right? What was the buy zone for next week, for this week rather, right? So in market open, you got your price where you get involved, and you are thinking about exiting the price at 780, right? But as we can see, we're getting challenge at this top. Right? So bulls rather, get the opportunity again to enter this trade to their profit target, right? So this is already planned the trade, right? So I use my arrows real quick. So this is this week trade. We don't get there yet. Boom, boom. This is this week trade. The week is not finished yet, but let's see how it goes, right? And after that, if that happen, we are looking for a pullback like this. If you're a bull, and taking it all the way up, right? Definitely. But as you know, this price right here is a bearish play, right? So as you can see, we are hitting resistance right here. But if we break out, we're looking for the pullback to continue with the move, right? But as a bear, you have, this is support, this is resistance, and you have all right to take it all the way down, right? Which is right now the price is at M3, which is a sell position, right? But the thing is, the price went above M3, so would I want a breakdown like this? Change the color real quick. So we are expecting a break of M3, right? A pullback up into M3, right? Same price. You're selling at the same price right now as is. But the thing is, you want a breakdown first and a pullback, and this would be your target, right? And this would predict a big double bottom, right? A big double bottom. And most likely we'll be having some profit taking around this area, right? So already we see which plan we trade for next week already, and this is just one currency pair, right? So your risk on in the market is coming down, risk off going up. That's just it, right? So thank you for attending. I would like you to like, leave a comment, rather type in which currency pair you want to go through, and we'll just go through it in more details, right? Yeah. Peace. I'm out.